Hey guys, so today we're going over financial fundamentals, the main lexicon and jargon that you need to know in order for you to understand what your accountant is talking about, what investors are talking about, and what other people are talking about when it comes to finances. I hope these things will make your life much easier because the way entrepreneurs look at money is different than the way professionals look at money. And I think there's a lot of confusion about these things, so that's what we're going to solve today. Let's dig in. For those of you who don't know me, my name is Ivo Pertz. I'm a serial entrepreneur and a business growth specialist. And just in the past 3 years, I've helped a fintech company move up market and start selling at a 5K price point. And they had a successful 8-figure exit within 9 months. I've also helped a manufacturer set up their direct-to-consumer approach and their e-commerce platform. And within 4 months, they had plus 7% to the revenue, but also plus 15% to the profit margin, because profit margins are much higher when you're working direct to consumer. And also I've helped the SaaS companies set up their sales and retention playbooks. And one specifically, after they did that, within 9 months, they had a successful exit as well. So just to name a few of these companies, we're going along and we're sharing this knowledge and we're sharing these implementations with more businesses as we go along. So if that interests you, get in touch. And on our channel, we are explaining how to use specific strategies to grow your business, and we're sharing the knowledge and the love during these sessions and during these videos. So come and join us, and we hope you like this information. Of course, Smoothin has got everything to do with cash flow and optimizing cash flow, because we believe that's the basis of any good business. And we also want to make it easy for anybody who's looking to start a business to understand how finances work from an operational perspective, and so that it's not complex and it's very easy for you to get your business up and running. So I hope you enjoy this content. Please follow us, like, subscribe, so on and so forth. So the first thing we're going over is something called cash-based accounting. So cash-based accounting, you can think of this as the way that, kids learn how to use money this way. And probably this was the way back when we started our first civilizations in how people would actually treat money and treat transactions. So it was very one-directional, right? It's like, I need to buy a goat. I go to the bazaar. I find a guy that has a goat. I give him money. He gives me the goat. The transaction's finished. There's nothing else. There's no more other discussions, right? So it's very one-dimensional. It's very simple. It's very short cycles. These kind of things, right? Similarly, as kids, we learn like I give you something, you give me something, and that's it, right? Like I go buy some other stuff, and so on and so forth. So it's like one-directional all the time. But as civilization went on, and as people started becoming more creative in their way that they're working with other people, and especially how they have economic relationships, we started getting the need to actually have another way of looking at finances, so that it's a standardized way and everybody can look at the same thing and look at it and make the same conclusions. So think about it this way. Looking at a cash-based profit and loss statement, for example, it's a good way for you to understand and like see where's money coming in, where's money going out. But for anybody externally, what it doesn't show is it doesn't show any other obligations, right? So it's very easy to manipulate a cash-based accounting statement, be it a profit and loss or whatever, because if you want to bump up revenue, ask your friends to pay you money that you've siphoned off somewhere in some kind of way, and you've bumped up the income, right? So it looks like you have a lot of profit when you actually don't have it. Then on the other side of things, like maybe you don't want to work with that, or you don't have any money to like run around with your friends to pump up the income numbers. What you can do is you just stop paying some of the vendors. So your expenses look like they've gone down, but actually you owe people money, right? So those are the risks that people needed to start looking at, and we needed to start evaluating. Once we started getting into transactions that are, multiple sequences behind them. So let's say a contract for 3 years, but there's a delivery every single month or once a quarter or whatever the situation may be, right? So that's cash-based accounting. It's a nice way to look at things, and it's probably the way that everybody who starts out looks at things, because that's, especially in the beginning, that's the only thing that's exists in the company, which is money going in, money going out. So, and you probably have very short type of terms and conditions with all of your suppliers and all of your customers, right? But this is where you get into trouble when you start talking to your accountant, because accountants, by and large, everywhere around the world, will work with accrual-based accounting. What's accrual-based accounting? That's what we get into next. So in the accrued way of looking things, you have the full picture. So it includes all the terms and conditions in the contracts and these kind of things, right? So that's got nothing to do actually with the money flowing, money going in or money going out, because that's a separate part, right? So before we jump into more details about accrual accounting, we need to go over 4 key terms for accrual accounting that you need to know in order for you to make wiser decisions and understand what your financial reports actually mean. So the first one is accounts receivable. So accounts receivable is basically all the invoices that you've issued that people still owe you money. So this is still money that's going to come in at a certain stage in the future, okay? Then you have the complete opposite, which is accounts payable. So accounts payable is all the invoices that have been issued to you that you've already received, but that you haven't yet paid for. Why do we have these 2 terms? Again, you might notice it's got to do with the flow of money. So in the first one, accounts receivable, you've issued the invoices, but you haven't gotten that money. You haven't gotten that money yet. But what you will do in accrual accounting is that you will put that as a profit already in the first month, but we'll get into the details a little bit later. Similarly for accounts payable, you've already received those invoices, but you haven't paid them, and that's how a way for an accountant or for anybody to look at, like, okay, how much have you got in payables, how much have you still got in receivables? There's also risks with the receivables, because receivables mean that you've already delivered the service. If the person doesn't pay you, guess what? You have to go to court, or if it's a small amount, you're just going to write it off, right? And you're just going to forget about it. So there's a risk there that money is not going to come in, or a portion of that money is not going to come in. And on the other side, accounts payable, for sure you're going to have to pay that. So that's another risk, and it just shows how big that commitment is. Then you have 2 more things, which are accrued expenses. You have accrued expenses, which are basically, you can think of these things as their expenses where you're receiving the service, but you still haven't received the invoice. So think of like a CRM system, for example. In this specific month, you might be using a CRM system, but they haven't yet invoiced you. But since you're using it and there's post-pay, then you're going to owe them money in the future. So this is a way of like looking at stuff that hasn't been invoiced yet. So you have 2 ways. You have accounts payable, which are the invoices that you've actually received, or you have accrued expenses, which is expenses that have not yet been invoiced, but you're forecasting that there will be invoices for those things. Then you have deferred revenue. Deferred revenue is basically work that you have done, money that you have received, but you still have to do work for it. So basically, there's a commitment from your side that you need to implement, or you need to deliver a good or a service for that company. So these 4 terms are quite key because they show like what's happening, where you're expecting money to come in, like how much money is expected to come in, how much money is expected to go out, and what are your commitments and obligations in front of all your other vendors and your other suppliers, and also your customers. Okay? So those 3 are quite important, because now you can start looking at these things and understanding, okay, that's what accrued expenses means, right? So I hope now it's becoming a little bit clearer in terms of like what the little bit of the differences are and these kind of things. We needed terms for them as a humankind because we needed to standardize everything so we can look at it. And these are the terms that we came up with. So these 4 terms, they exist only in accrued accounting. They do not exist in cash-based accounting. Now, please note, just because if you're looking at a cash-based accounting, and if your profit and loss is based on cash-based accounting, then bear into mind that you're probably not going to submit that type of profit and loss statement to the authorities. You're probably going to go with accrued accounting. At least from what I know, most of the countries, I've worked in 8 different countries, and all of those countries, it was always accrued accounting. Might be different somewhere else in the world, but For most of the Western world, that's the way it works. So all the things that you submit to the tax authorities are based on accrued expenses, and that's how they're going to calculate how much tax you owe for what specifically. Okay, so bear that in mind, that even if you're running operationally your business on cash-based expenses, cash-based accounting, you will submit a different document that has different numbers to the tax authorities. So keep an eye out for that, so you don't land into some nasty surprises of tax bills. Okay. So why is there the confusion? I think this is the first level of confusion generally out there when it comes to financial jargon and these kind of things. And the reason is, you can also think about it this way. So look at the table here, somewhere here. So when you issue an invoice, in the profit and loss and accrued, it's counted as profit. In the cash-based profit and loss, nothing happens because money didn't flow, right? When the money actually comes in the profit and loss, nothing changes. In the cash flow statement or in the cash-based P&L, it's going to show that the money has come in because money has come in. Similarly for invoices. When you issue an invoice, it's going to come up in the profit and loss as income. That's when in that month it counts that, like, that's the profit that you had for that month. So you'll be paying taxes on the results of the accrued accounting profit and loss for that month. Okay. So similarly for when you receive an invoice, in the profit and loss, it comes up on the date that you receive it. In the cash-based profit and loss, it would come up only when the money has left the account. One is based on the movement of the money. The other one is based on the actual date of when the invoice has been received, well, has been issued basically from your supplier, or when you issue it to your customer. It doesn't really matter, but both are the same. Okay, so keep that in mind, and that's why there's a lot of confusion, and that's why some people get into problems of like nasty surprises when they're like, oh shit, I didn't know I had so much profit, but I actually don't have that money in my bank account. Yeah, that might be because you have accounts receivable still to come in, or you had some other obligations from last year that you needed to settle, and you didn't think about it from that. So looking at both is a healthy way to run a business. Yeah, so due to this confusion, that's why we recommend asking your accountant to actually give you cash flow statements. Cash flow statements are a little bit different to cash flow profit and loss. It just shows you like the money that has gonna come in and go out on a specific month or a different period that you want to look at. But it gives you kind of, a bulk understanding of like how much net money is coming in or going out. What cash flow will not show you is other commitments. So anything that's been unpaid invoices, bills, anything like that, it's not going to have things like depreciation, amortization, write-offs, write-downs, or any accrued expenses, because it's just showing the flow. It's got no knowledge or no memory of other obligations and these kind of things, right? So what do some of these words actually mean? Let's dig a little bit deeper into that. And for that, what we need to discuss now is profit and loss and balance sheets. So what were profit and loss statements actually made for? So you might have noticed that I spoke about 4 key factors. Those four key terms are not going to actually come up in profit and loss. But it's a way that you keep the books so that you can make a profit and loss statement. What is a profit and loss statement? It's basically your incomings and outgoings over a specific period. So let's say usually it's the last 12 months on a monthly basis, usually. But it can also be on a quarterly basis. However you want to slice and dice your data, it's up to you, right? So what the profit and loss was created for was for people to have a standardized way to look at the company's health and performance over a specific time. So if, for example, you wanted to get a loan from a bank or from another partner or from whoever, they needed a way to look at your business and see, hey, is it tanking right now? Is it going up? What's happening? And the profit and loss statement is a great way to look at the company's performances over a period of time and see, okay, how things are moving, what seasonality looks like, these kind of things. So you could make a good bet on like, okay, the business has been doing like this over the past year. It looks like it's doing better and better and better. I'm happy to take the risk and give them a loan, right? So that's basically why we have these profit and loss statements in a standardized way. Now, what the profit and loss statement does not do actually is it says nothing about what's happened with the profit that was accumulated over the past years. So for example, you might have, if you're in business for 5 years or 10 years, you might have bought a property on year one, let's say a warehouse or something like that, and you bought it then. If you're looking at a profit and loss statement for the last 12 months, it's not going to show up there. It's not going to show up anywhere there because there was no purchase of those premises in that year. So the profit and loss, it's lost in the profit and loss statement, right? The other thing that you're not going to see is obligations that are set out in the future, specific type of obligations where you still have commitments or where you have deliverables that you're committed to. And that's why we figured out as human beings that we should have another document, which is called the balance sheet. So the balance sheet is a snapshot in time which shows the financial position of the company since its inception regarding finances. Okay, so what you're going to have for example, the balance sheet that you're not going to have in the profit and loss is, like I said, you're going to have assets. So you're going to have stuff that you've bought that is you own, that the company owns this stuff. So potentially it can either sell this stuff or rent it out, or there's some money locked in there, and depending on the situation, it can be used or unlocked in some kind of way. And the other part, and assets can be also money in the bank or investments or whatever, anything that the company owns that has no obligation for, anything that the company owns basically outright is an asset, is counted as an asset. And then the other thing that people wanted to look at is liabilities. And liabilities are basically commitments in the future, okay? So how much do you need to still pay out in wages, so on and so forth. And that's what the balance sheet shows. It shows how much you're going to owe and so on and so forth. But hold on, that's not it, because it gets even trickier. So not all commitments are in the balance sheet. And I think this is where it gets even trickier, and this is like the second level of confusion for everybody, because it depends on the relationship with the vendor if the transaction is actually going to, that contract terms and conditions are going to come up in the balance sheet itself. What I mean by that, let's have an example. I'll give you two examples. One case it will show up, and in another case it won't show up. So let's say you're using a SaaS CRM tool. What's happened, like if you pay the CRM tool for if you're paying this, let's say on a monthly level, or you're paying even on an annual basis, doesn't really matter. What matters is if you have a relationship where you still need to pay and the vendor still needs to deliver, that is not going to live on the balance sheet. You're going to have to ask for other type of contracts and other type of obligations that sit outside the balance sheet if you want to know that. But basically, because both parties have something to deliver, it's not going on the balance sheet. Think about it that way, okay? So if I still need to pay and you need to still give me the goods and services that I'm going to give you money for, it's not on the balance sheet. Whereas if one party has already delivered something, so let's say you leased a car and you're in the third year of a 5-year lease. It will show up in the balance sheet because the leasing company has already given you the goods and you have promised to pay off those goods at a certain rate for the next 5 years on a monthly basis. So you owe them a certain amount of money, and that money on the balance sheet is decreasing every single year because every single year you're writing off part of those liabilities, right? So I hope that makes sense for you guys, and now you have a better understanding of something. Just to make it even more interesting for you guys on the accrued expenses and these kind of things, for profit and loss, there's also another hidden kind of gem or hidden term that I want to share with you guys: expense recognition. So what is expense recognition? It's a way that your accountant is going to work with accrued expenses. And specifically, this is for expenses that you pay upfront for a year. So think all the SaaS tools, basically anything that you pay upfront for a longer period. What's going to happen is that, let's say in January, you have a bill for a CRM system that's for 30,000 for the whole year. What your accountant will do actually in the profit and loss is they're not going to put it in January that you paid 30,000, but they're going to split the 30,000 over 12 months and put it in every single month in the same amount. Why did they do that? Because that's the accrued way of doing expenses. Because you've paid for the year up front, and basically every single month that's the portion of that month's value of the contract. And this is where people get into a lot of trouble, especially when it comes to cash crunches and getting to cash crunches, because you don't think about these things. You just look at like maybe a report from your accountant and you're like, oh yeah, great, I'm making 20%, but then you have like a crunch month when it's like, hey shit, like for this and this and this, I'm paying upfront for the whole year. Yes, there's a savings for me for the full year because I get like a 20% discount or whatever the discount is, but that still leaves you quite vulnerable because it's a big chunk of money in a single space, and usually you're probably getting in money on a regular basis, like on a monthly basis, and so on and so forth. So either you need to save up or you need to find money elsewhere to plug some holes in sometimes. So please, please, please look at the profit and loss from your accountant, but also ask for your cash flow statement and compare the two. And that way you will sleep sound at night, have less anxiety, and hopefully now you can feel comfortable starting a business or moving into entrepreneurship, knowing this lexicon and knowing that it's actually not that complex, not that hard. So thanks for listening for me. If you like this type of content, stick around for the other series where we go over the basics, financial basics, so you guys shouldn't be afraid of starting a business. So thanks for watching. I hope you like this type of content and that this course was very helpful for you. If you want to work through these things live together with me, you have a possibility to do that. Just go to school.smoothen.ai, book an intro call, and we'll work it out. Either you go through a workshop scenario where it's a group setting, or we can do a one-on-one if you want to go into really the details of your specific business, and we can build this whole plan for you together. And so you don't have to think about these things and you don't have to think about how to implement it. We actually show you how it works, do everything for you together, and then you get all the benefits of actually implementing these strategies and looking at cash flow the way that you should be. Okay? So, catch you in the next one. Please like, subscribe, and share the video with anybody else that you know that might benefit from this type of information. See ya.